Introduction. In 1980, Warren Buffett once again proved why he's considered one of the greatest investors in history. Through his annual letter to Berkshire Hathaway shareholders, Buffett offered not just numbers, but timeless lessons in business, investing, and life itself. This letter captures a turning point in Berkshire's journey, a year of solid growth, deeper understanding of business value, and humility in facing inflation and industry challenges. Buffett shows us how to think about value beyond accounting figures, how patience and discipline compound over time, and why integrity and rational decision-making are a company's greatest assets. In this audiobook summary, we'll walk through 5 key lessons drawn from Buffett's 1980 letter. Lessons on value, earnings, inflation, discipline, and leadership. By the end, you'll see not just how Berkshire grew, but how Buffett's way of thinking built a philosophy that stands stronger than any market cycle. Chapter 1. Seeing Beyond the Numbers. The Real Meaning of Earnings. Buffett begins by explaining that not all earnings are created equal. In corporate accounting, only certain types of profits appear on the books, while others, especially from minority stakes in great companies, remain hidden. Berkshire owned small portions of outstanding businesses, and even though accounting rules didn't show those undistributed earnings, Buffett knew they were real and powerful. To him, a dollar earned by a business you partly own is worth just as much as a dollar earned by your own company, as long as it's reinvested wisely. He emphasizes that reported profits don't always tell the full story of a company's economic strength. The real measure of wealth lies in what the business does with its retained earnings. Buffett teaches us to look beyond the income statement, to think like an owner, not an accountant. The true value of a company lies in how effectively its profits are used to grow future earning power. Chapter 2. The Power of Retained Earnings and Compounding Value. In 1980, Berkshire's hidden earnings, the profits retained by companies it owned less than 20% of, were larger than its reported operating income. Buffett compared this to an iceberg. Only a small portion is visible above the surface, while the greater mass lies unseen beneath. These retained earnings were reinvested by capable managers like those at Geico and the Washington Post, compounding value over time without Berkshire lifting a finger. Buffett preferred this over holding full ownership of mediocre businesses that couldn't reinvest well. He also praised share buybacks by quality companies, calling them one of the best uses of retained capital when stocks trade below intrinsic value. Instead of chasing flashy acquisitions, great businesses quietly enhance shareholder value through thoughtful reinvestment and repurchases. Buffett's insight here is simple but profound. It's not how much a company earns, but how wisely those earnings are deployed. Chapter 3. Inflation, the Silent Thief of Wealth. Buffett's 1980 letter was written during a period of high inflation, and he warned investors not to mistake rising prices for real growth. Inflation, he said, acts like a hidden tax that erodes purchasing power and silently destroys capital. He illustrated that even a company earning 20% on equity could lose real value if inflation was 12% and taxes took another 50%. Investors might feel richer in nominal terms, but poorer in what truly matters. Purchasing power. Buffett emphasized that few companies can truly keep pace with inflation. The rare ones are those that can raise prices and grow earnings without needing to reinvest heavily in new capital. For everyone else, inflation eats away at returns, no matter how impressive the accounting numbers look. The lesson: focus on businesses with durable pricing power and light capital needs. In Buffett's words, inflation does not improve our return on equity. Chapter 4. Discipline, Patience, and Long-Term Thinking. Buffett's tone throughout the letter is calm, rational, and deeply patient. He doesn't chase short-term gains or get swayed by market noise. Instead, he sticks to simple, enduring principles. He explains how Berkshire evaluates performance not just by yearly profits, but by long-term growth in intrinsic value. In 16 years, Berkshire's book value per share had grown from $19 to over $400, a compound rate above 20%. That's the power of consistent discipline. Buffett also warns against the illusion of turnaround stories. Struggling companies that promise comebacks. He says when a management with a reputation for brilliance tackles a business with a reputation for poor economics, it's the reputation of the business that remains intact. His point is timeless. Success comes from owning wonderful businesses at fair prices, not fixing broken ones. Patience and rationality always outperform excitement and impulse. Chapter 5. Integrity, Leadership, and the Value of Character. Buffett closes his letter not with profits, but with people. He pays tribute to Gene Abegg, a banker and friend who embodied honesty and integrity. Abegg ran Berkshire's Illinois bank and remained loyal and ethical long after selling it to Buffett, a rare combination of competence and character. Buffett's reflection on Gene's life reveals his deeper philosophy, that business success flows from trust, ethics, and long-term relationships. Numbers can be audited, but character can't, and it's often the foundation of enduring value. He also praises the managers of Berkshire's subsidiaries, celebrating their independence and excellence. Buffett's leadership style is clear. Hire great people, trust them, and never interfere unnecessarily. In a world obsessed with short-term results, Buffett's letter reminds us that reputation and integrity are irreplaceable assets, compounding just like capital, only faster and with deeper impact. Conclusion. Warren Buffett's 1980 letter to shareholders captures the essence of intelligent investing. Patience, discipline, and integrity. He teaches us to look past surface-level numbers and see the underlying economics of a business. He warns against inflation's hidden dangers, praises the compounding power of retained earnings, and reminds investors that the true measure of wealth is growth in real purchasing power, not paper profits. Above all, Buffett shows that investing is not just about money, it's about mindset. It's about staying rational when others panic, trusting strong management, and thinking decades ahead. More than 4 decades later, these lessons remain timeless. The market changes, but principles don't. In the end, Buffett's message is simple. Focus on value, think long-term, and never compromise on integrity. That's how real wealth, financial and moral, compounds forever.